Let's conclude our discussions about futures and contracts by getting away from options a little bit. So is a security called a LEAP. This is a long-term equity anticipation security. They're pretty much long-term. They could be as long as 2 years. Now, remember that options and puts and calls typically have 30 to 90 days. So this is a longer time period. They're a little bit more expensive than puts and calls because obviously you have a longer time period, but they work exactly the same way as puts and calls. What about some other types of options, not on stocks? What do we have out there? So you have index options. The familiar ones, we have the Dow Jones, the S&P 500, but there are several different stock index functions. There are also some industry options. So you can buy options on the biotech industry or on semiconductors. So there are also other kinds of options on currencies, interest rates. You can get options on debt securities. And now, for most of this is really more for speculation type things or to kind of manage risk. So again, there are many types of options not related to individual stocks. I wanted to add here that the company has really nothing to do with these investments. They don't control the supply of options. They are created, remember, it's a bet. I'm making a bet with somebody else. So the company, quite frankly, is not involved with this type of security, even though the security's value is based on the value of the company's stock. There's something called a warrant. Now, these are typically used as sweeteners for bond issues. We may want to entice someone to buy our bond issue, so we offer these. Again, all of these options we talk about, they can all be American or European option. And of course, any of them can be sold prior to expiration. But these warrants, they typically have longer times of expiration. The strike price might actually change over time. You might have the right to purchase more or less than one share. So if you have a warrant to purchase 0.4% of a share or 0.4 of a share at $10, it's selling for $4, right? You might want to be able to compare that to one share. So one share strike price would be 10 divided by 4 cents, or a $25 per share equivalent. So the market price per share for the option should be around $4 divided by the 0.4, or $10. What is a future or a forward? Futures and forwards are agreements to purchase or sell an underlying asset on a specific date or a specific price. These things are typically not necessarily always on stocks, but a lot more of them on things like commodities and raw materials like oil or pork bellies. A lot of these investments are for speculation. I think a lot of the activity here, though, also for larger companies is to hedge risk. So again, these futures are sold on an exchange. However, forwards are more non-standard individual kinds of contracts, but they both act the same way. So just like options, you really don't need to buy these from a specific person. The contracts are created by the clearinghouse. So when the contract is sold, actually it is just unwound. So if you buy a contract, you say you will accept the asset at a certain price, at a certain date, at a specific price. You can sell before the expiration date. Most of these are not exercised. The term is they are unwound. So if you buy a contract, meaning you're going to accept delivery of the commodity, will profit your profit if futures price lower than the spot price, meaning the price itself rose. Well, futures price is $3, the spot price is $4. You can pay $3 and ultimately turn around and sell the asset in the market for $4. And of course, it works the exact opposite way with a sale. If you're speculating, then you purchase the opposite contract to close the position. Again, I mentioned this is what's called unwinding. All future contracts are based on a specific type of asset. Here they just mentioned corn, but it's more likely something like corn grade 5, a specific type of corn. So why do people buy these? Speculators are just betting on price changes. Hedgers, though, have a specific strategy. A farmer plants corn in the spring, but they're not going to know the revenue until the fall. How can they remove some uncertainty from their cash flows for the business? Let's say they typically harvest 100,000 bushels of corn. They need $200,000 to pay for the expenses of the farm and their living expenses. If they can find a contract or create one that will pay them $2 a bushel at harvest, then they're guaranteed to get their required cash. Now, what if at expiration, what if the price is only $1.50? Well, they don't care because they have a contract and somebody's going to pay them $2 per the contract. But what if the corn price is $2.50? They then have an opportunity cost, right? Or they're going to make some changes, maybe create another contract. So typically what they might do is unwind that contract and immediately buy another contract at that higher $2.50 price so they can lock in the higher income. So this shows how the paper or the internet publishes this information. So how do you make money? So let's say you buy one contract for $233. The value of that contract is 5,000 bushels times 233. That is $11,650. What do you have to pay for these? It could be as low as maybe 3%. Each contract has its maintenance agreement stated in the contract. So you know exactly what you have to pay. This is just an example of 3%. So 3% of $2.33 is 0.0699, or for this contract, you would pay $349.50. What if the corn price goes up a nickel? Now it's at $2.35. So the new value of this contract is $11,750. So the new value of this futures contract, the nickel times 5,000 plus the 349 of growth, means that you have a total of $599.50. If you divide the $599.50 by the $349.50 that you paid, that's a 71% return on your investment. This graph helps us see that most contracts are typically unwound as we get close to the delivery date. Again, out here is the delivery some date. You said that the open interest, the number of contracts, dramatically declines right up to the exercise date. So these last month, lots of people would be selling off or unwinding their contract in this position. What we find is sometimes speculators will purchase and sell, purchase and unwind daily because of all the potential price changes that could happen. So as I mentioned, one of the issues with margin is that every day there's a margin call. All accounts have to be brought to zero. The reason is the leverage impact on these changes in prices. Again, in this case, we have a margin as low as 10%. So that means for the a total value portfolio of 15,000, you're only paying 15%. If in this case the price goes up just a nickel, you have a $1,500 margin, which now means you've made $250. You can withdraw that if you want. But if it went down, that means you have a $1,000 loss, and you would have to make that deposit at the end of the day. The analysis of these securities is the same process as with stocks and bonds. We're just looking for indicators of data to help us make a choice. So we can do some fundamental analysis. We can look at some technical analysis, some charts and bars. We can, if they are managed futures, these things kind of work like a mutual fund. There are exchange traded funds that it's a traded portfolio based on a commodity index. So there's lots of ways we can get involved with these particular types of forwards or future contracts. The largest impact on the price here is the underlying asset. Some consider futures price a disclosure of the asset's future price. So if we use borrow funds to purchase the future, then we have interest costs also. If you purchase the commodity and hold it to meet those future obligations, you also have to then carry costs, right? So if your option is to buy the future or to buy the asset, if you buy the commodity, there are additional costs that you have to incur. So this is the benefit to buying futures, is you can buy a contract that represents the asset without actually having to take current possession of the asset. Stock market futures typically do what we do is we call them, as they say, they trade in cash only. So you can't take possession of the S&P 500. So at the very end of the day, there is just an exchange of cash. When it expires, if you still owned it, then there would just then be, again, an exchange of cash for that particular security. There is something out there called program trading. And this is really nothing new. It's been going on for a very long time. But essentially, this is when computers have an algorithm that tells them when to act. So what happens is if the market drops to a certain point, it's going to sell some securities. So the problems with this is, obviously, we have to worry about some transaction costs because things are going to trade and you're not going to tell them to do that. But the general idea here is that some of the bigger crashes have not necessarily been blamed on the crash itself, but the magnitude of the crash, because these algorithms don't know when to stop. So they keep on selling, which creates this downward spiral of prices. So what this graph kind of shows us is the cost of the security and the contracts that can indicate trading points, right? So here we can see the graph here. This, as the price changes, Here we see that the program triggers. When it gets above this zero point 0.1 calculation, it automatically buys. But when it gets down below negative zero point 0.1, it automatically then sells. So we can see that there's this automation that's in place that I think you can see might be have some issues if we're not careful with how they're used. We can also use futures for debt instruments and currencies, just like we can use them with options. Remembering that the difference between the two is that futures contracts are obligations, options are rights. And finally, there are strategies that are referred to as swaps. Sophisticated investors will understand the markets for their different types of futures within the same category. So there may be opportunities to increase some risk adjustment or actually increase profits by exchanging one type of, let's say, one type of currency futures for another kind of currency future or another future for the same currency, but have different, maybe different maturity, or maybe it has different price matches. So again, this whole idea of futures and options, it can be a little bit confusing over time. So again, this simple, hopefully little overview of these securities gives you a little bit of an idea of what they are, but hasn't given you enough information that makes you comfortable to want to try out and try your hand at this. We have other courses. We have a course in portfolio management that course will get into much more about futures and options, how the prices are determined, and a little bit more of the theory of pricing of all securities. So again, I hope to see you in the next video. Take care.